Welcome to FT Markets. China's stock market collapse and surprise currency devaluation shocked markets over the summer, and analysts revised down their forecasts of global growth. But is this such a bad thing for equity investors? Joining me to discuss this topic is Trevor Greetham, Head of Multi-Asset at Royal London. Welcome to the FT, Trevor. So our first chart, which should appear in a second, shows, what does it show us?
Okay, well this chart shows you, first of all, consensus expectations for the strength of growth in China. That's the red line. So when the red line is on the left-hand scale, you see it fell very dramatically in the 90s. It rose up to, at one point, an expectation of 11% GDP growth just before the financial crisis. Currently, the last 3 or 4 years has been declining very steadily. Now economists are only expecting about 6.5% growth. The blue line is commodity prices, and China's boom and bust cycles have been the real determining factor behind global commodity prices, and therefore we would argue global inflation.
And there was all this capacity that was built up during the...
Yeah, I mean, and particularly after Lehman failed, this precipitous collapse in expectations for growth when Lehman failed led to what was probably one of the biggest fiscal and monetary cocktails the world has ever seen. And a lot of that capital was misallocated. So you've got a lot of excess capacity China's trying to work off. They're trying to rebalance the consumer at the same time. They don't want to repeat the mistakes of the past with massive stimulus. And as a result, I think what we're seeing is a managed decline, which we think will carry on.
And then the impact of this on the global economy, which our next chart shows, is lower deflation worldwide. This chart has 2 measures of inflation. Just want to explain a little bit what they are. Yeah,
so the blue line is just headline G7 consumer price inflation. So the average for G7 is currently about 0. And in fact, in the UK, we've just seen the second month in a row of negative headline CPI month on month. The bar chart's meant to be a lead indicator for inflation, and that's proprietary. It's a scorecard approach that looks at spare capacity, commodity price trends, pricing power amongst industrials, and economists' inflation forecasts. And it's averaged over the world. And you can see for the last 3 years, while China's been slowing down, you've had this consistent downward lead indicator for inflation, just as you saw in the 90s, which was when Japan was one of the world's largest economies, and Japan was slowing down, creating deflationary pressure for the rest of us.
And this is a lead indicator, so it's telling us what is likely to continue in the future.
Exactly, yeah.
And then our next chart, which shows your novel approach to investment and the business cycle, which you call the investment clock. Well, what exactly is this telling us as well?
Well, this is a way of thinking about which investments do well at different stages in the business cycle. So the business cycle starts at the bottom left in reflation, when growth is weak and inflation's falling. You've got a disinflationary recovery at the top left, where stocks do best, and then overheat and stagflation are the stages when inflation's rising. If you've got this consistent drumbeat of disinflationary force out of China, you're going to stay on the left-hand side of this diagram a lot. When growth is weak globally, government bonds will do well. When growth is strong globally, and it's the developed economies that will be driving this, then stocks can do well.
And the reason why stocks are doing so well right now is partly because of all this liquidity that's being pumped in by central banks globally.
Yeah, so it's a long cycle because of China. So China slowing down has caused the Fed to skip a September rate hike. It's caused extra stimulus, we think, very soon in Europe from the ECB. We think there'll be extra stimulus from Japan. And also falling commodity prices. While they're bad news for emerging markets, they're good news for the US consumer. So we're seeing miles driven rising very rapidly, consumer spending's very strong. And this again is very similar to the 1990s, when commodity prices were weak, emerging markets were in crisis almost every year, and yet the S&P 500 index managed to double twice.
Thank you, Trevor. So there you go. So long as China keeps slowing down and inflation keeps falling, central banks will keep printing the money that provides a boost to equity investors.